This is part of the Sunbelt Business Broker Exit Strategy series that we started probably 3 years ago. And in the past, most of these presentations have been designed for sellers of businesses so that when the time's right for them to move on, they're well positioned to minimize taxes and walk away with what they were hoping to walk away with. We've decided this time to focus our energies on buyers versus sellers. I'm Joan Young, the president of Sunbelt Business Brokers. By the way, if you didn't know, Sunbelt is the largest business brokerage firm in the world, 5 offices worldwide. We're based in San Jose and have been helping buyers and sellers throughout the Bay Area for 14 years now. You know, one of the biggest challenges I've seen is with buyers really not knowing where to get help on funding a business that they found or that they're searching for. By the way, you don't have to use 100% of your savings or convince your retired parents to use their retirement money on your venture or go to family members and get them to lend you money. We found that not having partners in your business is probably going to be a working environment in most cases. So today I'll be facilitating the webinar, and our guest presenters today are Steve Stovall, who's Vice President of Business Development for Benetrends, which is based out of Southern California. And Steve will be discussing how buyers can utilize their 401k to help them buy the right business. So good afternoon, Steve.
Good afternoon, Joan. Thank you so much for having me today.
Sure. Our other presenter following Steve is Mark Affield, who's Senior Vice President and top producing agent for Wells Fargo, not just locally, but throughout the country. Hey, Mark.
Hi, good afternoon. Thanks for the invitation. I'm very glad to be here.
Sure. I've worked for years with both these gentlemen, and I really consider them financial experts, so I'm thrilled that you guys have made the time to be with us today. This is by far the largest attendance that we've ever had, so I think I need to change my strategy and make it more for buyers instead of sellers, guys. At the end of the sessions, we'll have 2-minute Q&A, so you can enter your questions in that left-hand box at the bottom, and I will get to as many questions as I can. And anything that we aren't able to cover, the phone numbers for Steve and Mark will be on the last slide. So if you'll kindly turn off your phones on mute, we won't be interrupted by ringing phones. So Steve, I think you're going to get started.
Okay. Well, it's my pleasure to be here today, and welcome everyone. I work for a company called Benetrends, and for the past 31 years, we've been helping people fund the purchase of businesses. The way that we help people do that is by using 401ks from a previous employer, non-Roth IRAs, annuities, and other qualified retirement plans. Many of you probably are not aware, but I'm going to tell you exactly how it gets done. Now, the lending environment has gone through a lot of changes, and Mark will talk very specifically about that, but everybody knows that having access to funding is the key to buying a business. One way is using retirement funds without tax or penalty. It's something that we actually introduced to the industry, and about 13% of all businesses that were sold in 2013 had some form of this type funding involved. Now, it's very popular. There are more rollover businesses done than ever before, and we'll talk a little bit about why it was created. We'll talk a lot about how it works, and we'll talk about the specifics. But think about it like this. If you have a non-Roth IRA, if you have a 401k from a previous employer and you got $200,000 in there, if you were to just do what most people do because they don't know better, if you were to just take that money as a distribution, automatically you're going to pay $20,000 or 10% as a penalty. And then at the end of the year, you're going to pay ordinary income tax, not on the amount that's left, but on the entire amount that you tried to access. So that's going to be $60,000. Most of us are in the 30 percentile tax bracket. So you take the 20, add that to the 60, and now you're looking at $80,000 out of 200, leaving you a net of $120,000. Now, I don't know about you, but I'm thinking that $80,000 could go a long way in making sure that my business, if it were breaking even, that it would be profitable. If it were profitable, that would make my business a superstar. That can literally be the difference between success and failure. Now, by using the Benetrends method, and I'll show you in the next slide exactly how it works, but by using the Benetrends method, you would be able to capture 100% of those $200,000 and invest that directly in your company. And here's how it works. Now, all of this is in line with Internal Revenue Service Code 4975, Chapter 13, and basically what it says is, step one, if you establish a corporation, and that would be a C corporation, and that corporation establishes a customized retirement plan, that's step one. Step two, the money that's in your old 401k, the money that's in your non-Roth IRA, in your annuity, in your thrift savings plan, in just about any retirement plan that's composed of pre-tax dollars and available as a lump sum distribution, you take that money and you roll it over from where it is into the newly created retirement plan. And remember, everyone, when you roll money from one qualified retirement plan to another, there is no tax. There is no penalty. Step three, the new retirement plan now buys stock in your new corporation. And think about what your 401k does anyway. You've got it invested in Yahoo, in Google, in Microsoft, or something like that. So instead of those other people using your money to make their corporation successful, you're going to use your money to make your corporation successful. And now that you've taken that retirement money and used it to buy stock in your corporation now has the capital to buy a new business, to pay you a salary, to pay your employees a salary. Any legitimate business issue can be settled by doing the rollover, because once the money is in your corporate checking account, it's no longer considered retirement money. Now we call it operating capital. Now, what are the benefits? Think about it. When you start a new business, most of us know that you never have enough money in a new business. So you don't have a loan repayment. Your credit score doesn't matter. There's no debt to credit asset ratio. It can be used as an equity injection for a small business loan. So you can work with Mark and I at the same time. You're able to save money because you make new contributions into the retirement plan. You build wealth. You pay yourself a salary from day one. That's going to take all of the concerns about replacing your salary out of the equation. You focus on the business, you focus on the business, you focus on the business, and the bills are still getting paid. Now, it's a one-time setup fee of $4,995. That's going to include complete incorporation, state filing fees, the company bylaws, the minutes, the stock certificates. And something that I only do for Joan Young's clients is California typically takes somewhere between 20 and 30 business days to establish a corporation. Because you're working with Joan Young, we will absorb the $600 California expedite fee and include that in the $4,995. The expedite fee takes your corporation time from 20 to 30 days down to 7 to 10 days. And if you are vying seriously for a business, sometimes 1 day, 2 days can be the difference between you and someone else being able to get that business. Now, we do all of the ongoing administration, so for those of you that think, well, it's all fine and dandy that you get the corporation set up, but what about all that other stuff? Well, all that other stuff is the document customizations, ongoing retirement plan analysis, stock valuation, tax saving strategies, 5500 form which has to be filed. All the things that the IRS, the Department of Labor, and the Treasury Department require be done, we take care of that for you, and we guarantee the work that we do. So leave yourself in our hands. We've got a pristine 31-year record of excellence, and we will take excellent care of you. And Mark, I think that's you now.
I just wanted to thank you, Steve. And we've had many, many people in the Sunbelt office and FranNet office here locally that have taken advantage of it. And Mark, what would you say the average time is that it takes once they do all their paperwork to be able to have their funds ready to go?
In the SBA world you're talking about? You're talking to me, right?
No, I was talking to Steve. I'm sorry.
Oh, that's quite all right. We're typically looking at 15 to 20 business days, about 3 to 4 weeks, from the time that they submit their paperwork to us till the time that they have money in their bank accounts. Sometimes it's a little bit longer depending on the company that is managing those retirement funds, the release. Sometimes they'll send a check or something here or there, but on average 15 to 20 days is something we can bank on.
Okay. And just one other question that came up, asking, it does need to be a C Corp, correct?
It does. And the Internal Revenue Service set that requirement. Just technically or technical housekeeping, for an S corporation to use retirement money as an investment and operating capital is a prohibited transaction. And LLCs weren't invented when this code was written, so it's not written to include LLCs. If the code changes, then we'll be sensitive to the changes, but we're very conservative and we do everything to the letter of the law.
Okay, thanks so much. And Mark Raffield is going to cover SBA lending and where it is today and where it's going and what you need to do to be able to get funded with SBA. Thank you, Mark.
You're welcome. Hopefully you can hear my voice okay. I have a very easy job, frankly. I've been doing one thing for going on almost 20 years, 20 years. And I really enjoy explaining the complexity of SBA financing in a very simple manner so that whether buyer or seller or anybody who is interested in learning about SBA, I really enjoy educating them so that they have a good understanding of it and realize that it's a wonderful program for business owners and in this case for buying an existing business. I want to explain over the next few minutes a bit about what SBA loan is all about. Also share with you my insight as a banker, what the SBA lending environment has been like for the past several years, the pros and cons of SBA financing, and also share with you, as being a former decision maker, an SBA underwriter, I want to explain to you in a very plain language as to how we review financial information and determine whether or not a business is worth financing. So to start with, I want to share with you the SBA lending environment for the past several years. Having gone through the Great Recession, I've never seen in my 19 years seen such a drastic impact on the economy with the recession having the economy and small business owners. And as you can imagine, as a nation's #1 SBA lender, Wells Fargo has taken a big hit in our portfolio. Many of our customers who would normally repay our loans back, many couldn't repay our loans back during the Great Recession, especially in 2009, 2010. And many smaller SBA lenders who have been very active for years were forced to shut down because they didn't have a source of funds to give SBA loans, and they were too scared to lend. So what that did was a stable bank like Wells Fargo with a very low cost of fund, and we were able to take advantage. And we frankly became one of the most aggressive SBA lenders during the recession. We rose to number one SBA lender ranking starting 2008, 9, and for the past 5 years, we have risen to be the number one SBA lender every year. We currently provide about 15% of all SBA loans in the country as a result. So what I see is that as other banks have become more conservative, we become the stable force in the SBA lending. As a result, we've captured much larger market share. So what I've seen during the recession is also a great number of buyers of businesses, many who had corporate jobs, many with a very high management skills, felt insecure, and I've seen a spike in the number of SBA loan applications to buy an existing business, utilizing their management skills. So that's the observation I've seen. Let's see here. What is SBA loan? So SBA loan it's a loan that is insured by the SBA, Small Business Administration. The federal government encourages banks to lend by taking away some risk. And how do they do that? They act like an insurance company. While 100% of the loan fund comes from the bank, such as Wells Fargo, what the SBA does is they tell us that as long as we make sound credit decision and lend and follow the SBA guidelines, SBA is willing to insure up to 75% of our loan amount in the worst case scenario of the borrower defaulting on our loan. So our risk is 25 cents to a dollar. So that is a huge incentive for us to lend. So as a result, when it comes to business acquisition loan, we're willing to finance up to $1.25 million unsecured, meaning if the buyer of the business does not have collateral to offer, that's okay. We're willing to go up to $1.2 million, $1.25 million without any collateral, as long as there is a sufficient cash flow in the business that we're financing. For business acquisition, we can typically go up to almost $2 million, $1.75 million. On a case-by-case, I've gone up to $5 million if the purchase includes a large portion of which is real estate, commercial real estate. So that's really the SBA loan program. Another program that we do offer is the SBA Express line of credit for working capital need after you buy the business. We do offer either a term loan or a line of credit called SBA Express line of credit up to $350,000. So the main advantages of SBA loan program is that it is a high leverage loan. We can go up to as high as 85% of the purchase price. Now, keep in mind that every lender is a little different. SBA does not tell the bank to require so much in down payment or how to underwrite the loan. Every bank has their own separate underwriting guidelines. But Wells Fargo being a very stable bank with a very good, strong experience in SBA lending, we can take a little more risk. Therefore, we can go up to 85% financing for business acquisition. A little later, I explain to you, what the SBA's requirement is in terms of down payment when a goodwill in a business acquisition exceeds $500,000, and I explain to you a little more in the next few slides. Also, SBA loan has a long amortization term. It's a 10-year term. Therefore, your monthly payment will be more reasonable. And lastly, the advantage of SBA program is that it does have no prepayment penalty. So it's a very flexible program. One drawback of SBA financing, I should mention to you, is that because the government insures our loan, SBA acts like an insurance company, and they charge a one-time insurance fee called SBA fee between 2.25% to about 2.625% based on the loan amount. So that's the main drawback of SBA financing, but those fees are typically financed. So when we look at a business acquisition transactions, we're looking at two sides, primarily the seller's financials. We analyze the seller's financials historically to determine whether or not the business is stable, and more importantly, it is profitable enough to repay the loan. That's the most important factor. If I were to put a percentage on it, I want to say 80% of the equation. The remaining 20% is the buyer's profile. We want to make sure that the buyers have certain characteristics, and I've outlined for you. Typically, we want to finance a buyer with at least strong transferable management experience, if not direct industry experience. That's very, very important. We've learned that over the years that not having sufficient experience really results in the business folding. It's such an important part of the equation. So therefore, we want strong management experience from the buyer. And we also need to know the buyer's living expenses, because before you can repay the loan back, obviously you got to pay yourself the sufficient salary to cover your living expenses. So we need to figure out what is your personal liabilities are, and we'll review your personal financial statement and tax returns to calculate that. And of course, we do require sufficient down payment. We want typically minimum 10% from the buyer. When we need more than that, we can allow seller to finance a portion of it via seller carry note, and I'll explain to you more as to how the down payment is financed later. And obviously, last thing is a decent credit score. In the SBA world, and we're not looking for perfect credit, but we do want minimum 640 FICO score. And that's frankly pretty low when you look at overall picture. Most borrowers that I see have FICO scores in excess of 700. So earlier I mentioned to you that I can finance up to 85%, sometimes 75%. The percentage of financing is really dictated by the SBA in this case. What the SBA requires is that they force us to look at a purchase price and quantify how much of the purchase price is intangible or goodwill. And the SBA says that if the goodwill or intangible amount is greater than $500,000, then the SBA tells all lenders, not just Wells Fargo, but all lenders, that we cannot finance more than 75% of the purchase price. The remaining 25% must come from the buyer, and if the buyer is strong enough, we can require 10% buyer injection plus 15% seller carry note. So that is the requirement. Now, in cases where the purchase price is less than $500,000, I can go up to 85% financing, whereby buyer can come up with 10% down payment and seller can carry a note of 5%. So one of the first things I ask Joan if she comes to me with a listing is, what is the estimated asset allocation or purchase price breakdown, so that I can determine how much goodwill or intangible there is. And by doing so, I can structure I know exactly what the maximum financing amount is, 85% or 75%. So to share my underwriting knowledge, having underwritten loans for many years, I want to explain to you how a lender determines whether or not a business is strong enough to demonstrate loan repayment. And the formula is really simple, and I've outlined for you. Really, there are 4 steps for us to calculate. One is I would look back to each of the last 2 years, say 2013 and 2012 seller's business tax returns, and each year I would quantify the net cash flow the business generated. And the net cash flow is a pretty simple formula. Their net income as per the tax return plus the seller's salary plus depreciation plus interest. Let's say that amount is $100,000. That's the starting point. So let's say business generates $100,000 a year. That's the starting point. And step 2 is for me to determine the buyer's living expenses, because buyer has to pay himself or herself before you repay the loan back. And there's a way for us to calculate that. And say I determine that the owner's draw or salary is $50,000 a year. I will subtract that from the net cash flow. $100,000 minus $50,000. The remaining net cash flow of $50,000, let's say, that is compared to the annual SBA loan payment, principal and interest payment. So, for example, if the SBA loan payment, annual payment is $50,000 a year, and the remaining net cash flow after subtracting the buyer's draw need is $50,000 a year, that ratio is 1-to-1. We call it debt service ratio. 1-to-1, the break-even in our world is not sufficient. We want a little better than that to deal with any sort of unforeseen contingencies. So the matching number we're looking for is minimum 1.25 to 1 ratio. In other words, we want the business to generate extra 25% cushion to demonstrate that the business has sufficient cash flow to repay our loan back, even after accounting for unforeseen contingencies, after the buyer buys the business. So that really is the magic, the formula we use to determine whether or not business is strong enough to obtain SBA loan. And ideally, we want to see 2 consecutive years of minimum 1.25 debt service ratio. As I mentioned earlier, Wells Fargo SBA has been a #1 SBA lender for the past 5 years. The reason is because we're very stable. We use common sense when we underwrite the loans. And frankly, we are more aggressive than many other lenders out there because we know how to assess risk. And as for me, I've been working for the same bank for going on 19 plus years. And I've been #1 producer for Wells Fargo for 4 years, over the last 14 years. And I really have a strong understanding of underwriting guideline. Therefore, I really don't waste time. I can pre-qualify loans fast. I have a 99% career loan approval rate. And I explain the loan process in detail to the potential buyer. And we work together in lock and step and anticipate issues up front. And therefore, I can close loans a lot faster than anybody else. So that's my background and expertise, and I'll be happy to answer any questions any of you have.
Yeah, and I wanted to just tell the group that Mark has done an amazing job with us, with clients that qualify for SBA, and he typically gets back to me immediately when I send him your information, and we often have just the initial approval within 48 hours, and then of course you have to fill out all the documentation. But Mark, how long is it taking now to get an SBA loan done from the minute you get everything from them that you need?
45 days or less is what I usually quote.
Is it? Okay.
Yes.
Okay. If you have any questions, write them in the box. Click over on the chat room. Let me open questions and see if we have any on this one. No, it's the chat. So if somebody, let's say, is looking, here we go, have a question from Doug. How do you handle loans greater than $1,075,000 outside the SBA limits?
Well, actually, it's the Wells Fargo limit. SBA limit is $5 million. That's the maximum SBA loan any individual can obtain. For example, You can obtain 20 SBA loans as long as collectively they don't add up to $5 million. Each lender sets the ceiling on how much they're willing to lend for certain purposes, in this case, business acquisition. And it's a guideline. We've made policy exceptions all the time. For example, I'm working on a car wash purchase deal, and I'm providing $5 million in SBA 7A loan for the business, the purchase of the car wash. Why? Because it's mostly commercial real estate tied, and the loan is fully secured with collateral. So. Another transaction I'm doing is, even though it's not a business acquisition, I'm doing a believe it or not, a startup restaurant transaction. I'm providing $2.3 million, even though our policy is no more than $1.75 million. Why? The person who's starting this restaurant is a well-known restaurant operator with a track record of success, and providing his home free and clear property that's worth $3 million as collateral. So from my perspective, it makes perfect sense. So to answer Doug's question, as long as you can provide collateral to fully secure the loan, we'll be happy to go above $1.75 million limit. Above $1.2 million, we want dollar for dollar collateral to secure the loan.
Oh, everything over 1.2, you need that? Okay.
Right.
Okay.
So I would typically go back. If the buyer does not have the collateral, then I would ask the seller to carry more. Maybe perhaps there are lenders out there that would do private equity financing for larger transactions with purchase price well above, say, $3 million, $4 million, $5 million price range. And I'm sure, Joan, you're familiar with those lenders.
Yes, absolutely. Let's say somebody's looking at a blue-collar business and they have owned one in the past, not in the same industry, but they're used to working with them, and they want to get an SBA loan. That would be management experience. That would be transferable skills, wouldn't it?
Yes. So when we look at the experience, we would assess, underwriter and I would ask the question, is this business highly specialized? For example, I think hotels are highly specialized, gas stations, restaurants, machine shops, those are highly specialized industries, for example. But, general businesses, I can always make an argument that the borrower has transferable management skills. How do I do that? One of the first things I do is I would ask the seller about the seller's background and what seller's day-to-day management responsibilities are, and I would ask the buyer to prepare a detailed resume highlighting their skill sets and what they've done. So my job is to connect the dots and show the underwriter that they have sufficient or very similar transferable management skills.
Great. I think I could probably handle the next question from Kathy. She says, do you find that most sellers in the Bay Area are able to wait as a buyer goes through the SBA process? Kathy, it really depends on how many offers happen to be on the business. So I just did one and are in the process of wrapping it up, and there were three offers, one of whom was an SBA lender. One of them was an all cash, and the other was going to be a combination of cash and I think 401k. So guess which one the buyer chose? He chose the all cash. But in most cases, there aren't three offers. That's unusual. So if you and the buyer and the seller hit it off, they know you would be very good for the business. They know your employees would like you and work well with you, which, by the way, is one of the most important aspects to a seller, is how are you going to fit in with the transition with their people, because this is their baby, and their employees are like family. So that is as important as anything else. But if it's most sellers, I would say, if there aren't multiple offers with somebody saying cash or SBA, then yes, they'll wait.
Maybe I can answer that question too, Joan, if you don't mind. To answer Kathy, I think 45 days is not that long, and I can only speak for myself, but Joan can attest that, it depends on lenders too. With some lenders, you'll be dealing with longer than 45 days, but with my process, typically it's 45 days or less. And within 45 days, I would think that any reasonable buyer, whether you're buying with cash or getting financing, I would think you want to spend at least 2, 3, 4 weeks doing your proper due diligence anyway.
That's true.
I cannot imagine seller being impatient if the loan process takes 45 days. And sometimes I think, cash, all cash is great, but I think that sometimes it's nice to have a bank that is used to analyzing sellers' financials to be in lockstep with you and do the proper due diligence too, because I can tell you that if I pre-qualify you and tell you that the loan's pre-qualified and you can get a loan up to 85% financing, that's a validation that you're buying a good business. You're highly profitable.
Yeah, and you're right. The due diligence in most business will be 3 to 4 weeks. You're really only waiting a couple more weeks. So any other question? I don't see any other. I want to thank you all for joining us, and thank you, Steve and Mark, for all your expert advice. And I think we have the last slide that will give you Steve's information. And whoops, Benetrends. Yes, there's Mark's at the top, Steve's in the middle, and my number's at the bottom for Sunbelt. So just be sure and mention to either of them if you call them where you heard about them from the webinar. And if you know of anybody that you think this would be helpful for, we tape our webinars for the Exit Strategy series, so they can go on to Sunbelt's webpage, which is www.sunbeltbayarea.net, and they can go to webinars and listen to it at their leisure. So thank you all for joining us, and be watching for your emails for the one next month. Not sure what we'll be covering, but hopefully it'll be timely for you. Thanks again, Mark and Steve.
Thank you.
Thank you, Joan.
My pleasure.
Bye-bye.
Bye-bye.
Thank you. Please stand by.